Welcome to the debate from MacroSpire.com. Before we begin, this content is for informational and educational purposes only. It is not financial advice and should not be relied upon for investment decisions. Past performance does not guarantee future results. Always consult a qualified financial advisor. Today, the hawk and the contrarian go head-to-head on oil shock stagflation. The 1970s playbook returns. Let's get into it.
WTI is knocking on $100, Brent already topped $112, and the Strait of Hormuz is effectively closed. This isn't a blip, this is the 1970s playbook coming back to haunt us.
And that's exactly why I'm buying. Every oil shock in the past 50 years, 73, 90, 2008, 2022, produced a sell-off followed by a recovery that rewarded people who bought the fear.
Except those recoveries happened when the Fed could cut rates. Right now the Fed is trapped, inflation is running hot and they can't ease without pouring gasoline on the fire.
The VIX is at 29.49. Historically, when the VIX spikes above 28, forward 12-month returns on the S&P are positive over 90% of the time. Fear is the buy signal.
The VIX measures sentiment, not fundamentals. It doesn't care that Iraq just declared force majeure on all foreign-operated oil fields and drones hit 2 Kuwaiti refineries.
Sure, but SPY is at $648, down 7% from its 52-week high of $697. That's a garden variety correction, not a crisis. The S&P has come back from worse dozens of times.
4 consecutive losing weeks wiping out all 2026 gains isn't garden variety. And the Russell is getting crushed even harder. Small caps can't absorb these input costs.
Which is why the trade isn't buying the broad market blindly, it's rotating into energy. The energy sector ETF is the obvious beneficiary when oil rips higher.
I'll give you that energy names benefit, but that's a sector trade, not a market call. You're telling people to buy the dip while margins are compressing across every other sector.
Margins compress temporarily. Companies reprice. They always do. The 2022 oil spike saw corporate earnings hit record highs within 2 quarters.
In 2022, the Strait of Hormuz was open. 20% of global oil and gas flows through that choke point, and right now it's shut. This supply shock is structural, not transient.
Structural is a strong word. Geopolitical premiums in oil have a shelf life. Diplomacy kicks in, alternative routes get used, and the premium bleeds out.
Tell that to the gas station owner watching wholesale costs spike while customers cut back. Margin compression hits Main Street before Wall Street even prices it in.
But the labor market is still intact. 92,000 jobs last month, sure, it's cooling, but that's not a recession print. Consumers are still spending.
92,000 is the weakest print in months, and that was before the full impact of $100 oil flows through the economy. Wait 2 more NFP reports.
I don't need to wait. Smart money is already positioning. Look at institutional flows into energy and value names. They're not hiding in cash, they're rotating.
Some of them are rotating. Others are building cash and buying puts. Don't cherry-pick the flows that support your thesis.
Fair, but you're cherry-picking the 1970s as your comparison. We have fracking now, we have strategic reserves, we have LNG exports that didn't exist in 1973.
And none of that matters when the physical choke point is closed. You can't frack your way out of a Hormuz shutdown. The bottleneck is transit, not production.
The bottleneck is also temporary. Markets are forward-looking. By the time the Hormuz situation resolves, you'll have missed the bottom.
Or the situation escalates further and you're catching a falling knife. Brent went from the low 80s to $112 in weeks. What makes you think $112 is the ceiling?
I'm not calling a ceiling on oil. I'm saying equities have already discounted a lot of this fear, and historically they over-discount geopolitical risk.
They haven't discounted a Fed that can't cut, a labor market rolling over, and an oil shock that's removing supply from the market for months, not weeks.
We'll see. But I'd rather be early buying quality names at a 7% discount than late after the all-clear sounds and the rally is half over.
And I'd rather preserve capital while the stagflation trap plays out. The 1970s comparison isn't hyperbole, it's a warning.
Every generation gets its 1970s comparison. The investors who bought through them got rich. The ones who sold got left behind. The hawk, the contrarian, thank you both. What do you think? Let us know in the comments. Read both articles in full at MacroSpire.com. Thanks for listening to the debate.